Imagine waking up and discovering that an investment you bought yesterday is suddenly worth far more today. That possibility is what makes the stock market so fascinating and so dangerous. But stocks do not magically create money. Behind every price is a real company, millions of investors, and a marketplace where expectations about the future collide every second. In the next 10 minutes, we will follow the stock market from its origins in 17th century Amsterdam to today's high-speed electronic markets and explain what actually happens when you press buy. To understand stocks, we have to go back to the early 1600s, when long-distance trade required enormous amounts of capital. One failed voyage could wipe out a fortune. The Dutch East India Company, or VOC, helped popularize a different model. Capital could be raised by selling ownership interests that investors could later transfer. This helped create an early market for company shares in Amsterdam. It was a major step toward the modern idea that ownership of a business could be divided into tradable pieces. Think of a company as a giant pizza divided into many slices. Each slice represents a share, and owning shares gives you an ownership claim in the company, not a specific physical asset. If a company has 1 million shares and you own 10,000, you own 1% of those outstanding shares. Your return depends on the share price and any distributions the company makes. And there is an important distinction. A profitable company does not guarantee a rising stock price. Investors are constantly pricing what they expect the company to earn in the future. Before an IPO, a company is privately held. If it wants to raise capital from public investors, it can go through an initial public offering or IPO subject to regulatory requirements. Investment banks may help structure and price the offering, while regulators review required disclosures. The company then sells shares to public investors and begins trading. The IPO price is not necessarily the price investors see afterward. Once regular trading begins, supply, demand, and expectations can push the market price above or below it. A stock exchange is a marketplace where securities can be traded under established rules. Today, much of that marketplace is electronic, even when an exchange has a famous physical floor. When you place an order through a brokerage app, the broker routes it to a trading venue or market participant for execution. You are not simply handing cash directly to the company. At the heart of trading are buy and sell orders. The highest available buying price is a bid, while the lowest available selling price is an ask. The difference is the spread. A stock price changes as market participants continuously submit orders at different prices. More aggressive buyers may accept higher asks, while sellers may accept lower bids. Earnings, interest rates, economic data, competition, news, and expectations about a company's future can all change what investors are willing to pay. That is why the stock market is really an expectations machine. Prices reflect what investors collectively believe a company's future cash flows and risks may be worth. Market capitalization is one way to estimate a company's stock market value. It is calculated by multiplying the current share price by the number of shares outstanding. For example, if a hypothetical company has 15 billion shares and each share trades at $200, its market capitalization would be $3 trillion. That does not mean the company has $3 trillion in cash. Market capitalization is the market's current valuation of the company's outstanding equity. There are two basic ways shareholders can receive returns. The first is a capital gain. You buy shares and later sell them for more than you paid, before taxes and costs. The second is dividends. Some companies distribute part of their cash to shareholders, but dividends are not guaranteed and can be reduced, suspended, or eliminated. There is also a crucial reality. Returns can be negative. A stock can fall sharply, and an investor can lose part or even most of the money invested. A bull market generally describes a broad period of rising prices and strong optimism. A bear market generally describes a broad decline of at least 20% from a recent market peak. These labels describe broad market conditions, not every individual stock. Even during a bull market, some companies can fall, and during a bear market, some can rise. Bull and bear markets can last months or years. What matters is that market conditions can change, sometimes much faster than emotions do. Sometimes optimism pushes asset prices far beyond what investors later consider sustainable. This is often described as a market bubble, although no single formula identifies every bubble in real time. When expectations reverse, selling can accelerate. Falling prices can trigger more fear, tighter credit, forced selling, and losses that spread beyond the original asset. The 1929 stock market crash was a major event at the beginning of the Great Depression, but the depression was not caused by the crash alone. Bank failures, monetary contraction, deflation, and international pressures deepened the downturn. Markets are driven by people, and people are not perfectly rational. Fear can make investors sell during a panic, while greed can make them chase right. One powerful behavior is FOMO, fear of missing out. Investors may buy simply because they fear being left behind, even when a price has already risen substantially. The opposite happens during crash. Panic selling can lock in losses. A disciplined investor focuses on evidence, risk, diversification, and a clear time horizon. Indexes help investors understand a market without checking thousands of companies individually. Each index follows a defined group of securities and a specific methodology. The S&P 500 measures large U.S. companies using a market capitalization weighted methodology. The Dow Jones Industrial Average tracks 30 major U.S. companies and is price-weighted. The Nasdaq Composite is broader than the stereotype of a tech index. It includes eligible securities listed on Nasdaq across many industries, although technology has a large influence. A century ago, trading depended heavily on human brokers and physical communication. Today, investors can place orders through digital platforms in seconds, while markets process enormous volumes electronically. Algorithmic trading uses computer programs to follow predefined strategies and can submit, cancel, or modify orders at very high speed. Strategies vary widely and are not all designed to trade constantly. Technology has made market access easier for retail investors, but speed does not eliminate risk. A fast order can still be a bad decision if the underlying analysis is wrong. One common mistake is treating stocks as a shortcut to getting rich quickly. Short-term speculation can produce large gains, but it can also produce large losses, especially with leverage. Another mistake is concentration, putting too much money into one company, sector, or idea. Diversification can reduce the damage caused by one investment performing badly, but cannot remove market. Investing and trading are different activities. A long-term investor may focus on business fundamentals and time horizon, while a trader may focus more on price movements and shorter-term opportunities. So what is the stock market? At its core, it is a system for buying and selling ownership claims in companies, with prices changing as investors reassess value, risk, and future expectations. So what is the stock market? At its core, it is a system for buying and selling ownership claims in companies, with prices changing as investors reassess value, risk, and future expectations. If this video made the stock market easier to understand, like the video and subscribe. The more you understand the system before entering it, the better prepared you are to make informed decisions.